Hey guys, my name is Max Convexity. Welcome back to my channel. I have a good topic planned for you today. It's called ZIVB. Where have you been all my life? I owe an apology. I've had a couple of viewers in particular that have been asking me to review this forever, and I've promised them for the past month, oh yeah, I'll do that. And I just haven't got around to it yet. Well, I'm getting around to it now, and I'm sorry I waited so long. It's an interesting deal. Well, I'll just say that much. All right. So this fund is kind of an unsung hero. It's only been around since April 19th of 2023, and it didn't start paying a dividend until December of this year. They paid 12 cents in December, 12 point something, and then they've paid 49 cents a month ever since, very consistently, and they're priced in the low 20s. So that's a nice return. It's a mid-20s return. The expense ratio, though, is crazy, or not total return, yield. The expense ratio is crazy on this thing, though. The expense ratio is 1.35. But they are up 75% in the past 12 months. So, I mean, it's hard to argue with results, but I was a little shocked. So then I started looking at expense ratios of competing funds, and there's no way to really talk about this fund without talking about SVOL. And I think I've promised other viewers I would review SVOL, and I've also neglected. So this is also going to kind of morph into an SVOL review. We're going to talk about both of them at the same time, but really SVOLs has reached unsung hero status also in a lot bigger way, really. And I didn't even realize this. So unfortunately, SVOLs, expense ratio is crazy also. So these funds are what I would call hedge fund replication. And so I'm saying that because I want to talk a little bit about it, but also they are complex. They're trying to replicate something hedge funds do. And this is something that hasn't been available to the public before. And so I can kind of see that they can maybe justify those, especially ZIVB that's up 75% in the past 12 months. I mean, it's insane. Okay. So, look at this though. This ZIVB only has 5 million under management, 5.5 million. I mean, that's, maybe it's a reaction to the expense ratio. I don't know, but yeah, it's a crazy small fund. They call it midterm future strategy ETF. I'll talk about the midterm in a second. SVOL is a great fund, and it's, gigantic. It's nearly $1 billion freaking behemoth, which is big for the covered call type funds. I mean, lots of these funds that I talk about, are $500 million, $250 million, something. Anyway. Okay. So I pulled the chart of ZIVB. I was almost thinking this is too good to be true. And I couldn't really find an explanation for how good this has been doing. Or it took a while to find an explanation. Let's just say that, but it's scary. It's, it's scary good. It's so good. But one thing I could think, the only thing I could think that kind of excuses it from being that good is they didn't pay a dividend for the first 7 months of their existence. So I don't know if they just retained the dividends. And then when they started, I mean, I don't know. There's not a lot of information. They aren't real transparent in the prospectus. If some of you guys know, I'm sure I'll hear about it in the comments. All right. In any event, this fund is is a burner. This thing's on fire. All right, so they're both monthly payers. SVOL is only paying 30 cents, but it pays it every month. Okay, hedge fund replication in the ETF business refers to the strategy of creating an ETF that mimics the performance of hedge funds or specific hedge fund strategies. Hedge funds often employ, confusing or complex investment strategies that are difficult to implement in real life. Most individual investors, or I don't know most, but a lot of them don't have access to hedge fund type strategies for one thing, because of the minimums. When I used to be in wealth management, it was 5 million before they'd even talk to you. To get to, I could easily, stockbrokers always help, or generally help people that, that are millionaires, in the low millionaires. But when you get up into the higher ranges, you no longer need a financial planner or a stockbroker. You need a wealth manager. And I did some of that too, but that starts at 5 million and above. And that's where and that's when you get access to these kind of things. I've never had 5 million. I don't know about you guys. I've just never had it, but nowadays you don't have to. That's it. It's a beautiful thing. So I can kind of see why the expense ratio is high. So these guys, what they attempt to do is to replicate the returns of the hedge funds, and they use different techniques. So they use something called factor-based modeling, where I'll talk about that sometime. They use statistical analysis. I'm always talking about statistical arbitrage, and I have my little Max's two-step, earning strategy, where I have a long short statistical arbitrage strategy. Well, it's similar to this. It's similar to a hedge fund type strategy. And then there's also investing. They also invest in diversified securities that exhibit similar risk and return characteristics to the hedge fund strategy. So these ETFs offer investors the exposure to hedge fund like returns without the limitations, associated. The main one being that, not a lot of people have $5 million. Okay, so here's some examples. Here's some actual funds that actually do this. I like this one, HDG Hedge. It's a ProShares hedge fund replication strategy. There's one of these that does the factor thing that I mentioned. And there's one that does the long short. The FTLS is similar to what I'm trying to do in Max's two-step. It's a long short strategy. And then there's also something called merger arbitrage, which is the first kind of arbitrage that I was fascinated with because of when I got into the airline calls in the late 80s, and then Trump put a bid in on United Airlines and I made a bunch of money on calls. That's called merger arbitrage. And they also have ETFs that do that. That's not as big of a thing as it used to be. Okay. The market's a lot more efficient than it was in the 80s. So let's talk about how SVOL and ZIVB work. And I don't want to get too into the details because these are complicated. And I just don't think we need to know everything about it. But if you guys have more questions, hit me up on Discord or on Facebook. All right. So these funds use futures instead of options. They use VIX futures. VIX is an index that follows the volatility of the S&P 500. Okay, so there's a force inside of VIX futures called contango. Contango is similar to the force that's inside of options, that make options decay. Okay, well, there's the force inside the VIX futures specifically that makes them decay, called a contango. Okay, the too long don't read is these trades have to do with the term structure of the VIX futures contracts. Term structure means they go out and look at the different months. And each month in futures contracts projects different levels of volatility. That's what the term structure is. Let's take a look at that real quick. I'm going to show you some basic stuff. VIXCentral.com is a good place to start. All right, I love this tool. So look at this. So the term structure slopes up and to the right. Up means more volatile. To the right means time passes. Look at the big hump in the term structure. Guess where that is? That's in October, November, that time frame. Guess what happens in October, November, So, the traders are anticipating that, and they've gone ahead and priced VIX futures more in that month. In any event, what these strategies do is they attempt to short futures. And as time passes, when futures have this condition called contango, which they're in most of the time, something like 80% of the time, the futures will naturally decay, and they monetize that. So, they're trading a derivative of a derivative. VIX is the derivative of S&P volatility, and they're trading VIX futures, a derivative of a derivative. I think it's a lot more direct, and it's basically the same trade to do what triple QY does or JEPQ does, where you just sell volatility in the S&P hit directly. But this is just a different way of doing a similar thing. Okay, so Prospecti. I was trying to be creative and think of, instead of saying prospectuses, but anyway, I don't even know if that's how you say the plural of prospectus. But the prospectuses the Prospecti were intense. I read them so you guys don't have to. I'm telling you right now, ZIVB is risky. It's too risky for my blood. So they just short futures, and that's all they do. Now, SVOL, their Prospectus, they short futures, and then they buy out of the money VIX calls just in case the worst happens. And I think we see that in the returns. VIX doesn't return, or SVOL doesn't return near as much. But, ZIVB is a pure short volatility play, and it is a burner, like I say. I mean, it's a burner, but I would not want to be around that thing in a bear market. That's just, Just my opinion, not financial advice. So get this, the prospectus for ZIVB even said the value of an investment in this fund could decline significantly and without warning, including to zero. You should be prepared to lose your entire investment within a single day. The shares will change in value and you could lose money by investing in the fund. The fund may not achieve its investment objective. Now, it's not a bad fund. I'm not trying to scare anybody, but I've never seen another have a strongly, but I never look at the leverage prospectuses. I bet they have that too in there, but that's a very strongly worded disclaimer. So SVOL, so okay, but just technically they short the front of the curve, and ZIVB shorts the middle part of the curve. And the middle part of the curve is a little less risky, and I think maybe that's why they can get away with it. But SVOL, when you short the early part of the curve and something goes wrong, like when COVID happened, oh my gosh, okay, you know, it gets ugly in a hurry. Here's what happened to volatility during COVID, if anyone forgets. All right, so you know, I think maybe ZIVB can justify not having the call option overlay because they're in the middle months. Okay, so I dream of big non-correlated returns. One of my viewers was giving me trouble about it yesterday because in my video yesterday, I was saying I dream of having a covered call fund that's so diverse you really couldn't lose too much, you know, on the market going up one way or down the other way, because you'd always have one to offset the other. And I was saying maybe you could have a 10 fund covered call thing. And I dream about that kind of stuff. And I'm not exaggerating. I really do. Or I really do think about this stuff all the time. I dream about the option tables. I dream about option trades. I'll say that for sure. So then I did this video today, you know, and this video actually gave me a better idea to the covered call strategy. We'll get to that in a second. But basically, what you're trying to do with non-correlated returns are you're trying to take out the effect of the NAV moving up and down in the different assets you track. As I always kind of say, erosion's misunderstood and a nuanced subject. But what worries me the most about these types of investments, or any bullish investment, is getting in an investment like Tesla right before Tesla drops 50%. And that's not erosion, that's Tesla dropping 50%. That's going to come through to the high yield fund too, to Tesla. With a little bit of buffer, thank goodness, because Tesla's selling options, but not a whole lot. So, you know, that's just kind of the way it goes. I don't really see any way to prevent that other than being able to predict the future. So we have other defenses other than being able to predict the future. Of course, it's to diversify, not be all in, and to take some comfort that the high yield fund does give you some degree of buffer just due to the yield it brings in. So let's look at some diversification subjects. Let's check out the diversification of ZIVB and SVOL to the SPY and see how that works. When you're trying to diversify, these diversification tables are your best friends. Okay. You can see right there, the SPY is 100. That means the SPY is the most dangerous. That means they index everything to the SPY. That SPY's volatility equals 1, right? Or the SPY's risk, let's just say. So actually ZIVB is actually more risky than SVOL. And that doesn't surprise me based on the prospectus. Now let's look over in the far right column. ZIVB also has twice the volatility of the SPY and 4 times the volatility of SVOL. So this is kind of making me feel better about saying ZIVB. It's a great fund, but it's pretty darn risky. So let's look at this way. The far left column where it's the correlation, that measures about how far the fund should move, or about how much percentage of the time the fund moves the same way as SPY is one way to think of that. So, you know, you can see plainly that that ZIVB moves with the SPY less frequently than SVOL, but not much. But what you can really see when you look in the far right column is that SVOL only has about half the return and about half the risk of the SPY, whereas SVOL has, like I said, has twice the risk of the SPY and 4 times the risk of the other funds. So part of the reason is because they don't hedge. They're just a straight short. You know, this will be great as long as things go all right. But if a Volmageddon hits or something, oh my gosh, you know. So SVOL, you know, by buying those extra call options, they're lowering their deltas or lowering their exposure to the direction of the market. So, and so I'm kind of liking SVOL the further I get through this review. Okay, so here's my suggestion, or here's the way, if you already have ZIVB, or here's what I did find a way that I could ZIVB. It's not financial advice. But you know, like I talked about making a covered call portfolio that was super diverse because I had 10 kind of less correlated funds in it. Well, here's a simpler way to do it. All you need is the IVB, 90%, you know, and then you need 10% UVXY. Now, UVXY was on that last slide also, and you can see that it's negative 89. So it's negative, so it's almost perfectly inversely correlated to the SPY. So it serves as it could serve as a hedge, and so could SQQQ. So negative numbers are hedging type situations, and a number that's like positive but that's less than 1 is a diversification opportunity. All right. So if you did it like that, though, I ran some numbers on that, and it'd be pretty nice. Now, ZIVB hasn't been around for that long, so it's kind of hard to tell. But I mean, I'm going to show you guys some projections I did. Now, UVXY does not pay an income. So your allocation now, if you did, you know, 90-10, instead of making 22 or 25% or whatever ZIVB's paying this month, it's about what it is. Take 10% off that. You'd be making, instead of 25, you'd make 22. Instead of 22, you make 20, or instead of 20, you make 18, right? Okay, so you take a hit to the yield of ZIVB, but that's still, you have a 20% yielder with black swan insurance built in. I mean, 10% UVXY. I mean, you know, this isn't the worst idea I've ever thought of. Let's go back to this slide. So this is what UVXY did during March and April of 2020. So, you know, if you did a monthly rebalance, and that's how I ran the portfolios that I'm getting ready to show you, you would have rebalanced. I figured it out. You would have rebalanced and bought UVXY at 6,000. And by the next month, when you had to rebalance again, you wouldn't have got all of this upside because you would have had to have perfect hindsight. There's no way you could have known to sell at the top. So, but it was 24,000. You had a four bagger. Now it's only on 10% of your portfolio, but that has some serious cushioning power to the other part of your portfolio. All right, so that's kind of the way UVXY works, and that's kind of why I like UVXY. But all right, so let's go to do this now. Let's look at this real quick, then I'm going to let you guys go. This is one of my longer videos in a while, but I hope it had some better content in it. That's what I'm going for. Okay, so I ran a couple of portfolios here real quick. My friend Echo Eversky taught me about this tool. I mean, I knew about portfolios, but this is a great internet tool to use. Okay, so first thing I looked at, wonder if we did 10% UVXY and 10% SVOL, would that help SVOL? And I compared that to just having 100% SVOL, okay? And then I compared that to having 100% SPY. So first, SVOL and ZIVB have different horizons they've been around. So I'm going to do a couple of different scenarios we can't compare them between time horizons. SVOL's actually been around about 2 years and a quarter. Okay, so look at this. So portfolio 2 is leading the way, and that's what I remember. Portfolio 2 was 100% SVOL. Okay, and it was leading the way. It made, and this is over the course of 2.25 years, it was up 18%. It turned $1 million into $1,180,000. 18% return. Good job, guys. So that's just SVOL by itself. If you did the SVOL and the 10% UVXY, you know, the hedge, you kill your returns too much. That 10% UVXY, you don't go anywhere. You don't get any growth. In fact, that portfolio is negative. So what I'm thinking is, because SVOL has a built-in hedge, because they have, and I was trying to prove it with this chart. SVOL, they have the call spread overlay. That's why they have return. They have less return. It's also why they have less volatility, but they also have less risk. But for that reason, you don't need to do 90% SVOL and 10% UVXY. However, you do this same thing on ZIVB, there's some really interesting results in my opinion. So let's go check that out. Okay, so I did portfolio one was 100% ZIVB and 0% UVXY. I don't know why I even checked that one. We know that one's going to be fire because there's no hedge. I mean, it's going to be great when times are good, and it's going to crash and go to zero in one day when times are bad. I don't know about one day, but potentially. Okay, and then we compared that to a 90-10 allocation of ZIVB and UVXY. And this was kind of my idea. I think this one portfolio is the best idea I've thought of in a while. And this is, I said I was going to make some covered call portfolios for like a rainy day or something, or I'm going to put together some non-correlated, good, like defensive covered call portfolios. This is portfolio one. Well, it's called portfolio two on here, but this is my first one I'm putting together. I'm going to put together some actual ones where I allocate with some different funds as well, of course. I'm not trying to get out of doing it. This is a nice alternative. Now watch these results. Okay. Of course, portfolio one, which is just ZIVB by itself, is going to be ahead. It's up 9.2%. And that's just since January. Okay. Now of this year, portfolio two, though, is the one I really like. It's up 5.9. We're going to call that 6%. It's up 6%, and it's been January, February, March, April, had 4.5 months. I mean, about a third of the year, a little bit more than a third of a year, but that's pretty darn good. It's pretty darn good considering that this has 10% UVXY, which will keep you out of trouble. It's like March of 2020 in times of really, really bad news. You can see he did a decent job here because you could see the portfolio, those 100% ZIVB. I ran the numbers on this, and their drawdown was twice as much as the one that had, well, I don't know if it's twice as much, but their drawdown was a little bit more. And of course we would expect that because adding UVXY, it's a hedge. So we would expect it to dampen returns because you're betting the other direction. It's like betting on black and red the same time at roulette, but this is different. But you do kind of kill your returns if you bet against yourself, if you hedge. All right. Yeah, I wanted to tell you guys, thank you so much for watching, but the caveat applied to this, as they do in all my videos. These high yield ETFs are risky. Even Jay Pestruccelli says they're a 4.5 out of 5 on the risk table, right? I think he says stocks are a 5 though. I'm going to ask him next time I talk to him. So these aren't as risky as stocks, but basically pretty darn close. And that's what I would say also. So let's remember our defenses. We're going to allocate. We aren't going to YOLO. We're going to strategize. We aren't going to pray. We should pray also, but not for stock market returns. We're going to diversify. We're going to dollar cost average. And we're also going to not be a dumbass. That's my main one. In other words, don't YOLO. Don't just get in something because it's down, hold on to it because you're stubborn. Diversify, allocate. Average, dollar cost average. All right. So this hedge fund replication topic is something I like to talk about, but I barely scratched the surface on that part of it, or really on the strategy these guys use, or really on anything. Even on my portfolio, I could have talked a lot more about that. I do think that 1090 mix of ZIVB, UVXY is worth looking into more. I'm going to have some more content on that and that kind of stuff. All right, so hit me up on Facebook, hit me up on Discord. I have a Max Convexity Facebook page. It's not a private group or anything. I've been thinking about making it a private group. I might need mods in the future if anyone's interested. I'm not a big Facebook guy, but I do have a profile nowadays, and I'm considering maybe making a I guess, a max convexity group, you know, since I don't have a Discord. I just don't want to do my own Discord. I like being in Retire on Dividends Discord for now, but I think maybe I should branch out into my own Facebook. Anyway, if you guys have any suggestions about social networks, let me know. But outside of that,